About half of Americans own no investments at all. No stocks, no index funds, no retirement accounts outside of work. And a significant portion of those people have money sitting in a savings account right now. The problem isn't access. It's not lack of money. It's that investing feels dangerous and doing nothing feels safe. This video is about why that feeling is wrong and what it's quietly costing you. The most common reason people don't invest is fear of losing money. That fear is real, and it's not irrational. It's wired into how the human brain works. Research in behavioral economics shows that losing $100 feels about twice as painful as gaining $100 feels good. Your brain doesn't treat gains and losses equally. A potential loss triggers a stronger emotional response than an equivalent potential gain. So when someone thinks about putting $500 into the market and imagines it dropping to $400, that imagined loss feels more significant than the imagined gain of it going to $600. This is called loss aversion, and it affects almost everyone. The problem is that loss aversion was useful when the threats were physical. A bad harvest, a predator, a failed hunt. It kept people cautious in situations where caution was survival. But in personal finance, that same instinct pushes people toward a choice that looks safe but isn't. Avoiding the market doesn't eliminate risk. It just trades one type of risk for another. The second big reason people don't invest is that they're waiting until they understand it better. This sounds responsible. Learning before doing is generally good advice. But with investing, there's a specific trap here. The more you read, the more complex it seems. You start with index funds. Then you find articles about ETFs versus mutual funds. Then someone mentions bonds. Then another person says you need to understand tax-advantaged accounts first. And suddenly, 6 months have passed and you still haven't opened an account. The learning loop becomes a delay loop. The information you need to start investing as a beginner is not that much. The complexity you encounter online is mostly relevant to people who are already invested and optimizing. Most of it doesn't apply to someone putting $50 or $100 into a broad market fund for the first time. The third barrier is the belief that investing is for people with real money. This one used to be partially true. Decades ago, brokerage accounts had minimums in the thousands. That's no longer the case. Today, you can open a brokerage account with no minimum balance. Many platforms let you buy fractional shares, meaning you can invest in a company's stock for as little as $1. A broad index fund, the kind that tracks the entire U.S. stock market, can be purchased for the price of a lunch. The minimum to start is not a number most working Americans can't reach. The barrier is psychological, not financial. Now here's the part that most people don't think about. Not investing has a cost. It's not visible the way a market loss is visible, but it's real, and it compounds over time. Inflation in the U.S. has averaged around 3% per year over the long run. That means $10,000 sitting in a low-yield savings account today will have the purchasing power of roughly $7,400 in 10 years, even if the number on your screen still says $10,000. The money didn't disappear, but what it can buy did. Now take that same $10,000 and put it into a broad stock market index fund. The U.S. stock market has returned an average of roughly 10% per year over the long run before inflation. Even after adjusting for inflation, the historical real return is around 7% per year. At 7% annual growth, $10,000 becomes about $19,600 in 10 years. In 20 years, it becomes roughly $38,700. That gap between $7,400 in real purchasing power and $38,700 is the cost of not investing. It doesn't show up on a bank statement. No one sends you a bill, but it's there. This brings up something most non-investors don't fully consider. Keeping your money in cash is a financial decision. It feels like a neutral choice, like you're just waiting, not doing anything. But it has a real outcome. You're choosing the certainty of inflation eating your purchasing power over the uncertainty of market returns. That's a trade-off, not a default. There's no opt-out from having a financial outcome. The question is just which one you're choosing. The market does go down. Anyone who tells you otherwise is wrong. In any given year, the U.S. stock market might drop 10%, 20%, or more. But historically, it has recovered from every single downturn and gone on to reach new highs. The people who lost money permanently were the ones who sold during the drops. The people who stayed in, or kept adding, came out ahead over time. The risk of investing isn't that the market drops, it's that you panic when it does. So what does starting actually look like? The first step is opening a brokerage account or a tax-advantaged account like a Roth IRA. This takes about 15 minutes online. You'll need your basic personal information and a bank account to link. The second step is deciding on an amount. Not the perfect amount, just an amount you won't need for at least 5 years. It can be $50, it can be $500. The number matters less than the habit. The third step is putting that money into a diversified, low-cost index fund, one that tracks a broad section of the market. You don't need to pick stocks. You don't need to time anything. You put the money in, and you let time do what it does. That's it for the first step. There's more to learn over time. How to increase contributions, how taxes work, when to rebalance. But none of that needs to happen on day one. Day one is just opening the account and making the first deposit. The cost of waiting isn't dramatic. It doesn't feel like anything. But 10 years from now, the difference between someone who started today and someone who kept waiting will be measurable in real dollars. Not because one person is smarter or richer or more financially sophisticated, just because one of them started. If this helped, subscribe. There's more like this coming.